All right, good afternoon, everyone. Welcome to our Phillip Security Research morning call for the 4th August of 2025, our afternoon session. First of all, we would like to wish you happy Singapore National Day this upcoming weekend. And back to the presentation. Today we have multiple stock counter updates. We have from the US market, we have, for example, Microsoft, Meta Platform, Spotify, and Grab, and more result update on the Singapore side. We have OCBC, CapitaLand, First REIT, and many more. And then, as usual, we have our technical analysis, our S&P 500, and also many more counters, and then some macro sector outlook for our Phillip macro updates and our, as usual, Singapore weekly update. And this is, as usual, our disclaimer page. Please be reminded that this is solely an educational purpose, and please seek financial advice from your financial advisor before you make any investment decision. All right, so we start our presentation with the Microsoft first. All right, so Microsoft released their 4th quarter result last week, and our financial year 2025 revenue and PATMI met our expectation at 101% of our forecast. So the 4th quarter revenue rose about 18% year over year, and this is driven by, again, the strength in the cloud services business, and the PATMI increased by 24% year over year due to the higher operating leverage. So in particular, the Azure Cloud Services business accelerated by 39% year over year, and this has been the main factor that driving the growth. Look at the positive factors. First, we have that we think that the Office 365 continues to show strong demand. Productivity in business process revenue, the segment for that particular business, grew about 16% year over year to 33 billion, exceeding the top end of the guidance by 2.3%. And then the Office 365 Commercial Cloud revenue grew by 18% year over year, driven by the customer base expansion and a higher average revenue per user. Paid Office 365 commercial users rose by 6%, led by strong demand from small and medium business and frontline worker offerings. And Microsoft 365 consumer revenue, which make up about a small portion of their revenue, grew about 20%, supported by the ARPU gains following the January price of 2025 price gain and 8% growth in subscriber. And the next point is on Azure revenue growth. And the Azure revenue growth accelerates. So in the 4th quarter, the Intelligent Cloud segment revenue rose by 26% to 29 billion, and this is driven by strength in cloud services. And this comes about 3% above the high end of the guidance. And it is driven by the Azure revenue, the cloud services business, which grew about 39% year over year. And again, this is well above the company's 34% guidance. So you see there about 5% gap between the guidance and also the actual result. So this is supported by the accelerated growth in the core infrastructure from Microsoft's largest customer. And revenue from Azure AI was broadly in line with what Microsoft expect. And this is the first time they released the Azure amount, and Azure has now surpassed 75 billion in annual revenue, which was up 34% year over year basis. And the next positive point is on the margin. We see improvement in the margin. In the 4th quarter, the operating margin expanded by 175 basis points to 45% compared to last year, which is about 43%, which is higher. And then despite this margin comes stronger despite a 27% year over year increase in AI and cloud related capex spend. The margin improvement was driven by the strong top line growth, which is 18% year over year, and which is above the expectation, right? The revenue and the higher operating leverage from continued operational discipline. The headcount remained relatively flat. Also, if you see recently, there are a lot of news on employee cuts. So we are trying to address right here. We are trying to address the news that this employee cut is typically, look at it historically, on year basis is around 5% or lower than 5% of the Microsoft global workforce, especially if you look at it from 2022 until 2024. And as usual, this software maker, Microsoft, they normally cut the cost whenever they see that the macroeconomic driven revenue would be slowed, right? They have been doing this many times before, and despite the recently announced 6,000 layoffs in May, the global headcount remained flat year over year at 228,000 employees as at June. So the reason is because they are trying to reduce the middle management layers, because they are trying to connect the top performers to the high management, meaning like no redundancy, like reduce redundancy. So look at what important is that they demonstrated efficiency again when they do that. The revenue per employee rise about 15% year over year to 1.24 million, right? So this is a good thing, the employee cut for the Microsoft. And look for the outlook for the full year, Microsoft emphasized a continued strong momentum. They project another year of double-digit growth in both revenue and operating income. And to address a significant contracted backlog of 368 billion, which is primarily driven by cloud and AI demand, the company increased their capex more, but at a moderate pace compared to what they did last year. Their capex for the next quarter will be around 30 billion and more, which is up from 20 billion in the last quarter last year. So Microsoft expect next quarter total revenue to grow by 5% and to be driven by 37% increase in Azure revenue. From this particular earnings call, what interests me is that the fact that we have all these large company and they continue to adopt Copilot faster than any other rate of their other products. So some large company that you guys are familiar would be Adobe, KPMG, Pfizer, Wells Fargo. They all purchased 25%. So they all purchased 25,000 seats for Microsoft Copilot. And what interesting is that when they do this and they see that this produce result, soon after they normally would upskill their purchase of this Microsoft Copilot. For example, Barclays, which is big bank globally, just announced that they roll out Microsoft 365 Copilot to 100,000 employees globally, from what they did initially at 15,000 purchase only. And the UBS also, they expand their own deployment to all of its employees after they initially only rolling out about 55,000 of them. So we think, you look at this, there's more room for them to upskill the AI and also their cloud services elsewhere, because there's so many demands from these large enterprises. And not only they're limited to the company, you see some news at San Francisco city, they enroll Microsoft Copilot to 30,000 workers in the city government after they did some tests, about 2,000 city workers after 6 months. So there's many more room for them to grow. And for that reason, we maintain our accumulated recommendation and raise our DCF base target price from 480 to 550. And we roll over to the new year. Microsoft continue to expect high earnings for Azure 37 year over year, despite facing supply constraint. However, we see upside potential given the backlog of 368 billion, which is 1.3 times of their financial year 2025 revenue. That is all from me. I will pass over to Serena.
Thank you, Fahmi. Next slide, please. Hi, good morning, everyone. I'll be presenting Meta second quarter result. So the result were actually within our expectation, with the consolidated revenue up 22% year on year at 47.5 billion. This is due to the strong growth in the core advertising business, which increased 21% year on year, driven by a better ad efficiency and higher user engagement. So in the second quarter, Meta actually see the user time spent on Facebook and Instagram actually increased 5% and 6% respectively, which leads to an impression growth of 11% year on year, especially in the APAC region. And because of their AI-powered recommendation models, the ad conversion on both platforms also grew 3% and 5%, because the model actually allows Meta to have more information about the user behavior in order to push more relevant contents. And the average price per ad actually grows slow but remain resilient at 9%. This is due to a strong advertisers' demand. The slowing of the growth is mainly due to a higher ad supply, because Meta is now trying to optimize their advertising volume, especially on the video surface. And this is why there is some downwards pressure on the pricing. And then regarding to the previous concern on the lower ad spending from the China-based retailer because of the end of the de minimis exemption, the ad revenue growth actually from APAC actually grew 18% year-on-year, and other region actually all grew above 20%. We think that it actually suggests a strength and diversification on Meta ad business to offset the impact. So for this business segment, we actually increased the financial year 2025 revenue by 3.5%. We do expect a 22% year-on-year growth because we do believe Meta AI spending will continue to pay off. Moving on to the non-core business segment, we actually do see some strength in WhatsApp and Verify subscription, which are actually the main driver of 50% family of app other revenue growth. Business messaging, which is one of the Meta 5 major opportunity they want to focus on moving on. We do see the momentum because the click-to-message revenue grew 40% year-on-year in the second quarter. And then regarding to the Meta AI, it currently surpassed 1 billion user, and WhatsApp actually serves as a larger driver of the queries. We do think that it actually suggests a long-term monetization opportunity because it will provide more insightful user data. And then regarding to the negative, Reality Lab actually report an operating losses of 4.5 billion, and the revenue actually grew slow significantly to 5% year-on-year. This is due to a lower Quest sales, despite the rising demand of the AI glasses. As for the outlook, Meta actually guided a revenue between 47.5 billion to 50.5 billion for the third quarter. And it actually suggests that they do expect a growth rate between 17% to 24% year-on-year. They mentioned that they will continue to spend on the AI-related investment, but they did not really raise the CapEx forecast this year, but they do narrow down the range by 2 billion from their previous guidance. Currently, it's around 66 billion to 72 billion. Meta will anticipate another year of similar CapEx dollar growth in financial year 2026, which is now around plus 30 billion year-on-year. So this is why we estimate financial year 2026, the CapEx will range between 96 billion to 102 billion. For long-term monetization, we actually do see some potential in videos and threads. For video contents, Meta mentioned that they do see a higher user engagement because the time spent on Instagram and Facebook video actually grew over 20% globally. We think that it could be useful in boosting ad impression, and currently has over 2 million advertisers are now using their Gen AI powered video generation tools, which could encourage more small and medium-sized advertisers to boost their ad spending. As for thread, we actually think, in the second quarter, Meta actually started to introduce ad on the platform. We do believe there's some potential growth in thread because the first reason is because Meta massive user base. They currently have more than 3.4 billion daily user across all the platforms. And then second one, it is designed to be closely integrated to the Instagram ecosystem. And for the valuation, we maintain an accumulate rating with the increased target price of $830 from $720. We do believe Meta ongoing investment in AI will continue to enhance the core product offering, leading to a stronger ad business. We also do expect this effort to boost AI capabilities could actually help them to unlock some of the potential in the untapped area, which I mentioned before, such as video threads and business messaging. And that's all for me. I'll pass the time to Helena. Thanks very much.
Thank you, Serena. I'll move on to talk about Shopify. So Shopify, it was overall a pretty mixed earnings. So if we just take a look at their second quarter revenue and adjusted PATMI, it actually fell short due to there has been some execution delay in the scaling of their ad capabilities. But the management mentioned that it's going to get back on track in the second half of the year. So if we just take at the first half revenue and adjusted PATMI, they were at 45% and 30% of our FY25 forecast. So jumping straight to the positives, they have very strong users growth. They actually outperformed better than their expected guidance. So they continue to attract more users onto the platform. They've acquired 18 million new MAUs in the last quarter. So their total MAU now is 696 million, which is a 11% year-on-year growth. Their premium subscribers also did well. It grew 12% year-on-year. So for Shopify, usually their MAU growth is actually higher than premium subscriber growth, because usually it takes time for people to slowly convert to premium account. But in this time, it actually outperformed their MAU growth. So this kind of indicate a very high rate of users upgrading to paid plan. So the company say that overall the health suite growth is because they have new features like audiobook that's included in the premium. Now they have add-ons that allows extra listening hours, and they have rolled out an AI-powered voice-activated DJ that enhances personalization and engagement. So all these seem to be working pretty well for them in terms of attracting new users. The second point is their margins are improving across both premium and as supported. So overall gross margin saw 230 BPS year-on-year improvement to 31.5%. Their premium gross margin was 33.1%. This is their highest for any second quarter. This is driven by their premium revenue growth outpacing their costs. For their as-supported gross margin, it was 18.3%, also the highest for any second quarter. This is due to their podcast and music gains. But they did guide that for the next quarter, the gross margin will expected to dip to 31.1% because they're thinking of a lot of near-term investment. So that's going to eat into their margins. Moving on to the negatives, their PAMI was negative actually because they have pretty high social charges this quarter. So for Spotify, they actually grant equity as part of the employee compensation. So when these share vest, Spotify, they need to owe a social security tax on the market value of the shares. And because the share price rallied so much ever since FY25, their social charges increases along the value of the vested shares. So that leads to the first negative PAMI in their last 6 quarters. We expect social charges to stay elevated because their share price is still pretty strong. So yeah, that's expected to last. And the second problem is their Q3 guidance is actually very soft. They've only guided a 5% year-on-year growth in their revenue. They've cited that they see a very strong currency headwind of around 490 BPS. And also, they're also guiding lower operating income and gross margin because of the high social charges, and also because they decided that their priority is to drive long-term strategic initiatives instead of just chasing short-term opportunities and to make it look good on the numbers. But with that being said, the ad revenue that fell short in the first half, they do expect it to catch up in the second half of the business. So overall, we keep our FY25 revenue assumption unchanged. We decreased FY25 PAMI by 12% just to account for the extra social charges after the share price strength. Our DCF target price remain unchanged at $600. We upgrade our recommendation from reduced to neutral due to the recent share price drop. So that's for Spotify. I'll move on to Grab. So for Grab, we really think it's a super app strategy delivering skill efficiently. I'm sorry, the graph is supposed to be two decimal place. We've already updated on the report. It's not reflected here yet. So some of the number you can't see clearly. So overall, the second quarter revenue and PAMI met our estimate. The first half revenue and PAMI were at 47% and 17% of our FY25 forecast. The PAMI was low only because they were not making profit earlier the year, but we do expect PAMI to be backloaded in the second half as the company turned profitable. So moving on to the positive, first is they're seeing very strong growth momentum in on-demand services. So on-demand services means both mobilities and delivery add up together. So mobility and delivery both grow strong, 19% year-on-year and 23% year-on-year respectively. The company is adopting a counter-cyclical strategy right now. They're trying to focus more on affordability. So they roll out features like saver delivery, saver transport ride, so that kind of attract price-conscious consumers. Their monthly transacting users, MTU, which is a key leading indicator for them for their GMV and revenue, it grew 13% year-on-year, still considered really healthy. And on-demand GMV actually rose faster than the MTU. It rose 21% year-on-year. So the fact that it rose faster, it kind of signals Grab's ecosystem flywheel at work. Because once users join, they tend to engage with multiple services and spend money in different services. So that kind of drives their GMV up. So this behavior we see as a very good sign because it enhances their user stickiness, improves consumer retention, and supports a more stable and recurring revenue over time. The second point, their financial services is expanding very fast. It grew 41% year on year, reaching 84 million in the second quarter. Their loan portfolio grew 78% year on year because they're seeing rising demand from Grab's either driver or merchant partners or consumers. They all prefer a very convenient app-based financing. Grab has been introducing a lot of affordable and accessible products like microloans, BNPL, insurance. All these are tailored to the Southeast Asia market where traditional banking penetration is relatively low. So these products, they are able to meet the unmet financial needs, particularly among the underbanked population. And one thing that works in their favor is because they're a very data-rich ecosystem, the data actually allows them to have a better credit scoring. So that enables them to expand their lending while keeping their non-performing loan under control. Their NPL right now is only at 2%. So if you want to benchmark, for a global bank is usually 1 to 2%. For a fintech company is usually 3 to 7%. So for them, it's considered doing very good. And the last positive point, they have a lot of new product rollout that's gaining traction. New product rollouts such as group orders, Grab Food for One, and Grab Mart enhancement. So all these have started to drive accelerated metrics. These new offerings, they're growing around 3 times faster the speed than the legacy businesses. And now Grab Mart itself is contributing to about a third of the delivery GMV. Within Grab Mart, there's a lot of potential to tap into because online grocery currently only penetrates less than 5% in Southeast Asia. So we do see these new initiatives potential direction for their further expansion. Grab's guidance for their FY25 remains unchanged. They've guided a revenue growth of 19 to 22% year on year. But management did indicate that they expect a much stronger second half performance compared to the first half due to first, because mobility and deliveries, they're both driving sequential growth. They're building off acceleration that we've seen in the current quarter. And second, they have the new product rollout, such as Grab Mart, that they're seeing a lot of traction. And third, because their regional corporate costs rising around 10% year on year, which is slower compared to their revenue growth. So that kind of signals a good cost leverage into the second half of the year. We think overall it delivered a very strong set of numbers. We think what Grab really benefit from is their entire ecosystem that kind of create a lot of synergies. So the moment they able to acquire a user, be it mobility, then the people will start trying to explore other sectors. And there's a lot of synergy, like because they collect so much data, they're going to be able to use it for their financial arm. So all these has been helping them a lot. But with that said, there's still the same risk that they still maintain. The competition is still intensifying. They're still paying a lot of incentives in order to remain competitive. And they're seeing a lot of temper growth in macro headwinds like Indonesia and Thailand. But overall, we do see them transitioning into a very profitable phase. We have not changed our assumptions for FY25. So our target price remains the same at $5.8, and we maintain the buy recommendation. So that's all from me. I'll pass my time to Darren.
Yeah, thanks, Helena. Yeah, I'll run through Class's results. So the first half, they've got similar to the start of the year, they've committed to a stable DPU for this year. So year on year, 6.1 cents. Yeah, so for the results was in line with our expectations. So usually the first half is slightly weaker than the second half because of seasonality. Yeah, but for this half, the gross profit was stronger, 3% higher. By that, inside there were many like new acquisitions, AI completions, and there were some divestments also. So if you strip that out, year on year on a same store basis, the gross profit was up 4%. So the DPU was lower 1% year on year, but there are many one-off items. So on a core basis, DPU was stable, but having said that, the last year, first half 24, there was some additional other income also, like 6 million. So we strip that out, so DPU would have been higher. Yeah, so for the positives for Class, most of the key markets registered year-on-year growth. So there are key markets that includes France as well, which is on master lease. The other key markets are in the table on the top right. Yeah, so that contributes about 80% of the gross profit. So most of that registered year-on-year growth. You see Japan is down 23%, but that's mainly because of the acquisition of one of a budget hotels. So that really drove the RevPAR down because the ADR was way lower. Yeah, so if you strip that out, the Japan RevPAR was up 10%. And for Singapore, it's the only country that's down on the same store basis. So that's down 3%, mainly because of the softer first half. Like first half of 2024, as we all know, last year was extremely strong. Like there were Taylor Swift, Coldplay, and such, all the major events. So it was expected it will be down slightly this year for first half in Singapore. Yeah, so far the first half they had some higher occupancy, so 78% versus 75%. So going forward, we still expect like mid-single digit RevPAR growth, so around similar levels like 3%, 3 to 5%. That's mainly from higher occupancy, as we've seen the improvement in occupancy year on year. Yeah, so their financial position remains very strong. So cost of borrowing remains stable. We're expecting it to decline slightly from lower interest rates, like lower 3-month SORA especially. And but the impact of that won't be so great because they have 82% of their debt already hedged. So just improve slightly this FY. And on top of that, they also issued 260 million perps at 4.2%. Yeah, and that is mainly to redeem the perps that is outstanding. So that is at 4.68%. So that will result in some interest savings for them. Yeah, so for the outlook, they've announced 3 new AEIs. So one of it is already complete. So there are another 2 more new AEIs other than the Cavendish London. So total and there'll be 4. So there are 4 AEIs remain, and that doesn't include the Somerset asset. So yeah, so I mean the Clarke Quay redevelopment. So that's 4 AEIs remain. So the capex is 255 million. So Class's share will be 145 million. And like the weakness in Singapore, we see it down. So we're expecting it to remain kind of weak in Singapore as well from the lack of like major events and the high base especially. So the stronger performance in other countries like US, UK, the strong geographical diversification will offset some of the softening demand that's seen in Singapore as well. And on top of that, Class, they also have a 300 million undistributed divestment gains that they can use to top up. And for forward bookings, still okay. So they are trying to lock in forward bookings from corporates as well as partnering with event organizers to capture all this event-driven income or event-driven demand. So that will help to have a base and uplift occupancy. Yeah, so with that, no change in our TP. So $1.05 dividend yield of about 6.7 cents. Yep, next slide, please. Yeah, so moving on to First REIT. So First REIT, as usual, they're mainly hit by the FX. So other than that, the portfolio remains very stable. So gross revenue, you see it down 2.9%. That's mainly because of the depreciation of the Indonesian rupiah. So previously they did not hedge any rupiah, as you all know, they are undergoing the strategic review to assess the sale of all the Indonesian hospitals to Siloam. So because of that, they didn't hedge previously, but the depreciation of Indonesian rupiah was just too strong already. So that really impacted the numbers for First REIT. Yeah, and so overall DPU is down by 5% mainly because of the depreciation of the rupiah. Yeah, other than that, their performance remains resilient. Like the rental income in Indonesia grew by 5.5%. So they have a 4.5% base rental escalation in Indonesia. So the 5.5% growth is a better performance-based rents from the hospitals that are contributing performance-based rent. Yeah, and their capital management remains stable. The cost of debt increased slightly because more loans were drawn down and amortization of upfront interest costs as well. So just increased slightly, but going forward, we're expecting that to come down because only 56.2% of their debt is hedged. Yeah, so for the rentals owed by MPU, previous quarter was 5.8 million. So another quarter in the rental outstanding increased by another 1.2 million. So now it's 7 million. So the silver lining was that they paid 0.9 million in July. So they've committed to an installment plan, so they are going to pay bit by bit. So that is a positive. So there are signs that they are starting to slowly repay the debt that they owe. And like I mentioned again, the FX really remains the most significant headwind for DPU growth. Like currently, the Japanese yen is fully hedged and Indonesia is 50%. So at the start, like I mentioned, the first half, because of the potential sale of all the Indonesian assets, they didn't really want to hedge because you never know if the sales suddenly comes through, then they'll be stuck, they're locked in with all the hedges without any income. So they didn't want to hedge, but now they see that really the rupiah has depreciated so much, they really need to put some hedges in to at least lower the risk. So as a result, they hedge 50% in the near term. Yeah, so for the Siloam's LOI to acquire the hospital asset, so no updates yet. So more updates to come as it gets released, but definitely no. I mean, but in the meantime, no material developments yet. Yeah, and at least for First REIT's base, like 80% of the portfolio is from Indonesia. At least that has a 4.5% base rate escalation that could possibly help to offset the depreciating rupiah. Yeah, so with that, we lower our DPU slightly because of the FX, and as a result, our DDM-TP it dropped slightly, also to 31 cents from previous 32. So despite the FX headwinds and the lower numbers, we are still expecting a forward yield of 8.4%, so that is still relatively resilient and still quite attractive in our books. Yeah. Yeah, next slide, please. Yeah, so now I'll talk about Astrea. So I become Phillip's part-time credit analyst also. So I did a report on Astrea 9 as well as the report on the previous issues. So if you want, can take a look. So I'm just going to roughly briefly talk about the Astrea. So if you do not know, Astrea is a fixed income instrument. So it's kind of backed by cash flows from private equity funds. So basically, it's still a bond that will pay a fixed yield. So there are some safeguards for it. So one of it is the maximum LTV ratio is 50% for the Class A bond. So and the current LTV is at 48%. So basically, the NAV is like double of the LTV, and they also have a reserves account. So on every distribution date, they'll put in $75 million into this reserves account. So that will accumulate, and as on the scheduled call date, that accumulated amount in the reserves account will be used to pay off, or rather used to call back all the principal, and that will be on the 8th of August 2030. So those are the two main structural safeguards. So the table at the bottom shows the details. So for Class A1, so that's in SGD, so that is 615 million total amount. So the public offer to retail is 280 million. The placement tranche is 235, and for the Class A2, the public offer is 50 million. That's in USD, so the interest rate is higher, 5.7%. And for the Class GPIK, that is not available to retail, so that's only the placement tranche. So yeah, if you're a retail holder, you can't buy the Class GPIK bonds. Yeah, so how to purchase? Basically, you can purchase through ATM, IB, internet banking, or mobile banking through the 3 local banks. The second option, place order through Phillip Bond Desk. As of the latest update this morning, I believe that is already full. It was available to AIs, accredited investors, but the allocation and allotment is already full already, so they do not take in anymore. So now even if we call that number is don't know whether to pick up, but basically you can't buy through Phillip anymore. You only can get it through the internet banking or the first option. So the timeline is that, yeah, it opened last week, and the closing date is on 6th August, so that's 2 days time. So if you want, you gotta quickly go to your internet banking, and the trading date is 11 August. Yeah, so just to note that the interest rate, take a look, A1 is at only 3.4% as compared to last year, about 4.35, and A2 is 5.7. Yeah, and yeah, basically the stats are all here. All 3 bonds are also investment grade rated. Yeah, and if they do not call back on a scheduled call date, which is in 2030, there will be a 1% step up for A1 and A2. Yeah, next slide, please. Yeah, so basically left is a simplified priority of payments. Yeah, I won't run through that. Basically, Class A1 and A2 as senior priority over the Class B. And yeah, for the right-hand side is basically the current price and current Astrea bonds are outstanding. You take a look at the most recent issue, Astrea 8, as last year. It was issued at 4.35, and for Class A1 and Class A2 in USD, it was 6.35. So basically, you've seen the interest rates really fall. So it's almost like 1% lower coupon rate you get when you invest in Astrea 9 as compared to if we have invested last year in Astrea 8, 4.35. Yeah, that's all for me. Hand over to Meow Meow. Thanks.
Thanks, Darren. So Singapore Airlines released the first quarter result last week, and it's a major miss. Yes, it's underperforming our expectation, mainly due to lower income, and also a 122 million share of loss from its associated company, which is Air India. And we do expect the loss from associated company to be a recurring issue for SIA. Yeah, as Air India was the most significant loss contributor for Tata Group in FY25, with loss widening around 48% year-on-year. And as I believe it's still premature to quantify the financial impact of Air India Flight 171 incident. And the airline has canceled 8 flights, and also seen booking decline by 20% after the incident. And there's also 18% drop in average airfares. Yeah, but something positive about SIA is they refresh its record of passenger in first quarter 26. So it increased by 6.9% year-on-year. And we do anticipate contribution from Scoot from first half 26 onwards would increase, as second half is seasonally stronger, and also they probably will gain more market share following the exit of Jetstar Asia. And we also expect FY26 earnings to be supported by depreciating US dollar. It has depreciated around 4% quarter on quarter, and also lower jet fuel cost. So including hedging, jet fuel cost declined by around 8% year-on-year. And this is mainly due to a 17% decline in its fuel price. And around 2/3 of the operating expenses in US dollar. So we do anticipate this will alleviate the cost pressure for SIA. And something negative is cargo revenue is expected to be volatile, especially with the ongoing geographical tension and the US tariff related issue. So we do anticipate both cargo and passenger yield to continue to trend down in FY26. However, it will be at a slower pace compared to last year, and the absolute amount will remain above pre-COVID level. So second quarter 25 booking is still looks healthy at the point of time, but SIA didn't expect any material impact on its financials from the exit of Jetstar Asia. Yeah, so we do maintain a reduced call with lower TP of $5.94, and this is at 1.1 times of SIA's forward PE. Yeah, that's all for SIA. Next slide, please. Yeah, so Far East released the first half result last week, and DPU declined by 9.2% year-on-year to 1.78 cents, and this is in line with our estimation. And the drop is mainly due to lower contribution from hospitality segment. Yeah, so Far East do experience dropping RevPAR of around 6% year-on-year, and this is trending below pre-COVID level, which is out of our surprise. And the drop was mainly due to a combination of dropping ADR and also occupancy rate. And this is driven mainly by absence of large-scale events. So last year has like Taylor Swift and Coldplay, and Lady Gaga in first quarter didn't have meaningful contribution for RevPAR at a group level. And for its service residence portfolio, it didn't immune to the overall RevPAR decline. So average occupancy in first half fall to 78%. And this is mainly due to the ongoing AEI, and also softer corporate demand. Yes, but Far East expect further improvement in second half 25, with forward booking appear promising. Yeah, however, Fries indicated that recovery from Chinese and Indonesian travelers is still slower than expected due to the ongoing trade war and also FX impact. And there's some last-minute booking from neighboring countries, which is supporting the ADR growth. And they do expect RevPAR to bottom up from August onwards. And but however, there's still like challenges for the Orchard for the hotels located at Orchard area due to supply influx. And since like F1 is going to be overlapping with is going to be overlapping with Golden Week this year, so they do expect year-on-year decline in RevPAR in September. Yeah, so we do maintain a buy call with unchanged DDM TP of $0.7, and FIS is trading at forward dividend yield of 6% and 0.7 times price to NAV. Yeah, and we expect DPU upside to be supported by lower financing expense, since finance expense declined by around 16% year-on-year in first half 25, and they expect around 20 basis point saving for the full year FY26. Next slide, please. And for Elite UK REIT, first half 25 DPU surged by 10% year-on-year, yeah, which is in line with our expectation. And the improvement was mainly attributed to a 5 percentage point year-on-year increase in its payout ratio. Yeah, so payout ratio is well maintained at 95%, and also a 12.8% year-on-year saving in their finance expense. And Elite has divested 6 million worth of asset year to date, with average price 8% above its valuation. And there's another 33 million in the pipeline, which is potentially to be monetized in FY26. And Elite is also actively negotiating with its largest tenant, DWP, for around 25% of its lease renewal ahead of the 2028 expiry. Yeah, and we do expect rental reversion of around 20 to 30% upon successful negotiation. And long-term share price catalyst is expected to come from its portfolio rejuvenation. Peel Park, which is around 6% of the total portfolio value, is now valued at 33 million, has secured a 120 megawatt power. Yeah, and so we do expect it to be divested by FY26 with a price at least 50% of the latest valuation. And Elite is also trying to grow its PBSA portfolio, since they have just secured approval of one of the property, which is Lindsay House, with target ROI of 18%, and they secured around 168 beds. And they're trying to grow the portfolio to around 350 beds. Yeah, so meaning they'll convert 2 of the asset into PBSA. Yeah. And for outlook, Elite has just acquired 3 new properties with total consideration of 9 million, reflecting 7.6% discount to the valuation. And we expect this to be 0.6% DPU accretive. And further DPU upside is anticipated to come from interest saving in this year, as our cost of borrowing declined by 40 basis point year-on-year to 4.7% in second quarter 25. And yeah, we expect another 10 to 20 basis point saving, yeah, for the all-in cost of borrowing. Yeah, so we do maintain a buy call with higher DDM TP of 0.39 pound. Elite is trading at forward dividend yield of 9% and 0.8 times price to NAV. Yeah, that's all for me. I'll hand over to Glenn for OCBC. Thank you.
Okay, thanks, Mel. Yeah. So yeah, for OCBC, I think the main highlight was that they lowered their guidance for net interest income, and also I think it was quite a disappointing set of results from them. Their second quarter earnings were below our estimates, mainly from the continued net interest margin compression, which led to lower net interest income. Their first half PATMI was only at 47% of our forecast. So for dividends wise, it also fell by 7% year on year to 41 cents. But they did maintain their dividend payout ratio at 50%. Yeah, more details on this on the dividends later. So just jumping straight to the positives. First positive is that their wealth management and trading income helped to offset and buffer some of that decline in the net interest income. So wealth management fees rose 32% year on year. It has continued to rise, mainly from higher customer activities as well as a higher AUM base. The customer activities is quite expected, as interest rates are continuing to decline. They also had higher AUM, and it was driven by net inflows of around $4 billion for the quarter. For trading income, it was also higher, but at a much lower pace, only at around 6% year on year, really from the increase in customer flow income from both their wealth as well as their corporate segments. The second positive, which is their provisions have improved. So it finally went up. I think it was 2 straight quarters of increase in provisions. And then I think in this quarter, it declined by 21% year on year. So the improvement was mainly due to lower specific provisions, which were partially offset by higher general provisions. So general provisions were higher because the previous year there was a write back of 10 million, and now it's 49 million. But then again, they are still continuing to place these general provisions into management overlay. So it's not that they need or there's higher NPLs, it's just that they are placing it. But I think it's less than what you see in the previous quarter. So they're cutting back on this because the net interest income decline was I think larger than they expected. So they are cutting back on piling on more allowances. Yeah. For negatives, the main negative being that the NIM compression has continued. So this is what really hit their PATMI. If you see PATMI declined by 7%. So net interest income declined by 6% year on year, as the NIM compressed further to 1.92%. So it's about 28 basis points year on year decrease. So this wasn't even able to, the loans growth grew by 7%, and it wasn't even able to offset much of this NIM compression. The NIM compression for OCBC, it was really due to their Sing dollar and Hong Kong dollar loans repricing down faster than the drop in deposit costs. So for OCBC, they only did, I think, one or two. The most recent one only came in effect on 1st August for their current account, their flagship 360 account. Yeah, flagship 360 current account. So they announced it a month ago, but it was only came into effect on 1st August, right? So the flow through from this deposit cuts will only be seen in the third quarter earnings. They also did mention that half of their loan book is in Sing dollar and Hong Kong dollar, with 80% of the Sing dollar as well as almost all of the Hong Kong dollar loans are on floating rates. So that's the reason why they were so affected by the lower rates. And that is what hit their net interest margins as well as their net interest income. More on the guidance later. So the second negative would be that their insurance income also disappointed slightly, mainly from losses arising from the asset liability mismatch and also the revaluation of private equity holdings. For the guidance, for the outlook, the guidance is that they have lowered the net interest margin guidance. So now they're guiding for 1.9 to 1.95%. Previously, they were saying it could hold stable at 2%, but I think the decline in especially the HIBOR, came in as a bit of a surprise. That's why they are now lowering it. They have also, I think it's the first time that they have given net interest income guidance. So they are guiding for net interest income to decline by mid-single digit. I think previously when we put in the numbers, we saw that net interest income could increase by very low single digits, but now there will be a mid-single digit decline. The rest of the guidance they have maintained, so mid-single digit loans growth, cost income ratio below 40%, as well as credit costs 20-25 basis points. So all this in, what do we expect for OCBC for 2025 is that we do expect their earnings will decline by around 2%, mainly from this continued compression in net interest margins and the decline in net interest income. And with the continued growth in wealth management and fee income and trading income, this would sort of help to partially offset that compression in NIM. Yeah. So as for the Trump tariffs, they haven't really said anything new, but that the initial impact was still, the first order impact is only around 3%, and also that the second order impact is quite difficult to quantify. But they did caveat that by saying the majority of their customers are domestic players. All in, we do downgrade to neutral from an accumulate with a lower target price of $16.50. So as I said earlier, we do expect their earnings to decline by around 2%. And I think another factor that is, I would say, putting OCBC apart, in not a very good way, apart from their peers, is that their dividend yield is the least predictable amongst the three banks because their dividend policy is fully floating, right? Fully floating meaning that they give a dividend payout ratio of 50% base and then the 10% special dividend, which is their capital returns, right? So that is why we saw their dividend per share actually falling 7% year on year because earnings fell. So if you keep the payout ratio stable at 50%, dividends will also naturally fall. So that's why their dividends are entirely dependent on the direction of their earnings. But we do believe that they can go above this minimum dividend payout ratio. So this 50%, the question was asked to management and they said that this is only a minimum, right? They will have to relook at their capital at the year end to see if they can go above this 50% and also the 10%. That's why we think that they can continue with this special dividend at least for 2 more years because they have enough capital. And they also have the highest CET1 ratio amongst the local banks. They currently still have the highest. Their second quarter fully phased in CET1 is around 15.3%, and their optimal CET1 or target CET1 is actually 14%. So they still have this 1.3% buffer that they need to clear, and they will not do it if they don't do many acquisitions, or also when they will not if they're not giving back more dividends, then this will always be stuck at around 15%. Yeah, and then that 1.3% equates to around, I think, $3 to $4 billion. So they have more than enough room to actually clear and to give higher dividend payout ratio, like maybe what their peers are doing, like DBS is doing. Yeah, so that's all I have for OCBC. I'll now hand it over to Zain. Thanks.
Thanks, Glenn. Good morning, everyone. So next, I'll move on to an update of the FOMC meeting last week. So the FOMC voted 9 to 2 to hold rate steady at 4.25% to 4.5% in line with market expectations. And there was also a first double descent on a rate decision since 1993. However, this was well telegraphed. Voting against were Governors Bowman and Waller, who preferred to lower rates by 25 basis points at this meeting. Governor Kugler was absent and did not vote. In the second point, in terms of the notable changes in the latest FOMC meeting as compared to June, the committee actually downgraded its view of the economic conditions. So some of the wording included growth of economic activity moderated from economic activity has continued to expand at a solid pace, and also uncertainty about economic outlook remains elevated from has diminished. And the last point regarding what Powell has spoke about during the press conference, he reiterated his wait-and-see approach. He did not offer any hints about a rate cut in September. On the impact of tariffs, he mentioned that we are still quite early days, starting to show up in some of the consumer prices. However, the wider impact remains uncertain, and he expects to see more of these impacts in the upcoming data. And he also made it clear that inflation was still a concern as part of the dual mandate. Next slide. Yeah, so in terms of outlook, from the press conference, Powell adopted a firm and hawkish tone that was leading to a pullback in terms of rate cut expectations post-meeting. However, following the jobs data on Friday, we have actually seen the traders actually reprice 2 25 basis cuts this year with 80% odds of a 25 basis cut in September. And when we look at the 3 months average drop is currently about 35,000 following the downward revisions. And unemployment rate is about 4.2% and remains low and stay in the narrow range consistent with full employment. Core PCE year on year is 2.7%, still above the target of 2% by the Fed. Yep. And also the Friday jobs data actually showed that from the household survey, the labor participation rate was down to 62.2%, lower since November 2022. And also we've seen that long-term unemployment actually heated up. In terms of those out of work for more than 27 weeks, actually climbed to 1.82 million. and it represents about 1/4 of all unemployed. However, when you look at other metrics such as the number of quits, job openings, vacancies to employment, weekly unemployment claims are actually remaining quite stable. So we've seen a slowing in terms of job creation and supply of workers are actually broadly in balance, which was mentioned by Powell during the press conference as well. So overall, the picture of the labor market weakening has become much clearer now, with the hiring momentum continuing to soften. However, it's likely not in crisis. Powell actually also mentioned that he expects a short-lived tariff inflation impact as a reasonable base case, and he actually emphasized the important metric to look at would be the unemployment rate. And he also talked extensively about downside risks to the labor market, which I think he had mentioned about 6 times during the press conference. So that actually builds up the case for 25 basis cuts in the September meeting. Unless the labor market deteriorates further with maybe like averaging less than 50,000 jobs, and also if we do see labor slack build up, moving out the range between 4 to 4.3%, then that might support the case for 50 points cut. Then for all in all, the last point would be that investors will also pay attention to the upcoming Jackson Hole Symposium that's taking place end of this month, 21st to 23rd August, for any remarks on monetary policy, because this symposium had actually historically featured a major policy speech from the Fed chair. Yeah, next slide. Yeah, then this is some of the updates since the FOMC meeting. So we actually seen the resignation of Governor Kugler. So this will be effective 8th of August. She has actually served since September 2023, and her term originally expires end of January next year. So this will pave the way for Trump to put in his own nominee for the board. And in terms of some of the other comments from the FOMC members following the jobs this Friday, we've seen Governor Waller and Bowman explain the reason for the dissent. Mostly talking about they see a one-time increase in terms of the tariff inflation impact, and they believe that risk in delaying taking action could lead in deterioration of the labor market. And second most important person will be the Vice Chair Williams. So he says that labor market is still solid in my view. We'll go into September meeting with an open mind. So it's still keeping more of a neutral kind of tone. And we look at some of the members like the Cleveland Fed President, alternate member Hamek. She mentioned that job market is still healthy in balance, but right now the Fed is missing more on the inflation side. And also when we look at the Atlanta Fed President Bostich, he mentioned that risk to inflation is much greater than risk to employment, and he's not ready to increase his projection for 2025 rate cuts. Next slide. Yeah, so I'll move on to some of the technicals. First one about S&P 500. Last week we saw a pullback from the major trendline resistance. So this was connecting, I think it was 2021 as well as 2024 highs, around 6,400, and last week was down 2.3% for the index. So I think this week we're likely to see some sideways consolidation going ahead, with the next support level around 6,200, which was the support we see in the first half of July when the index was actually consolidating the range. Then the next level of support down will be likely around 6,120. So that was the highest previous range resistance highs in February this year. And for now, resistance likely to be at 6,285 to 6,335 areas. So I think we're likely to see some sideways consolidation after a 2-day drop for the index. Currently, index also trading below some of the 5, 10, 20 short-term moving averages, which we have not seen, I think, since April. So this is quite a bit of a pullback taking place recently. Next slide. Next one, for the ETF monthly July, we titled it mostly sideways or down in August. So in terms of the ETF performance, most of them were in the green, with the exception of US Treasury bonds and gold, which was both down 0.5%. The top gainer was ETF tracking Bitcoin, which was up 8%. In terms of the current trends, S&P 500, Bitcoin, Singapore equities, as well as Hang Seng Index are in an uptrend. US Treasury bonds, gold, and oil are in a range consolidation. For August, we expect S&P 500, oil, and Singapore equities to pull back. For US Treasury bonds, gold, as well as Hang Seng Index, we expect some sideways consolidation. And for Bitcoin, we do expect a bit of rebound to take place. Next slide. So first out on the S&P 500 ETF view, we've seen that price actually retested this uptrend channel resistance in blue. So we're currently doing a bit of a pullback. So we could see a retest of the 560 level, which was a previous all-time high in February this year. So we could see some slight pullback from this area of resistance this month. Next slide. Next one for the Treasury Bond ETF IEF. Mostly we still seen a range consolidation, so that explains the quite muted price action since June and July as well. So generally it's between like $92.80 to about $95.80. So we do maybe see a sideways consolidation as it approaches the resistance closer to $96. Next slide. The next one for the Gold Mini Shares Trust is also just sideways. We've seen it consolidating in this bullish flat consolidation since middle of April this year. So that I think that's still likely to be unchanged. We're likely to see some continued sideways trading going ahead this month. Next slide. Next one for the Oil and Gas Exploration Production ETF, XOP. We've seen the price actually forming a bit of a lower highs recently from a downward resistance line. So we could see some retest near-term supports at 119 to 122 areas. So that could be, we could see some slight pullback about 3 to 4% to actually retest this support area. Next slide. Next one for the Bitcoin Strategies ETF, price actually broke out of a bullish come and handle formation at the start of July. However, towards the end of the month, we've seen some pullback. But price actually retesting a previous resistance area about $20 to $20.50. So we expect price to actually find some support after 3 weeks of pullback from the highs and actually do a bit of a rebound to maybe retest about $21.50 again. Next slide. Then for Singapore Equities ETF ES3, we've seen a stellar month in July. So price actually was very strong bullish momentum where there was weekly gains in July. Price actually broke out above this short-term uptrend channel resistance at $4.18. And towards the end of the month, we see some pullback taking place. So I think we could see some continued pullback this month after a very strong July. So we likely to actually retest $4.18 again. That could represent about close to about 1.4% pullback from Friday's last close price. Yeah. Next slide. The next one for the Hang Seng China Brothers Index ETF, price also rallied upwards towards the rising wedge resistance area. So that's close to about 95 Hong Kong dollars, and we've seen some slight pullback at the end of the month. However, we think price is likely to do a bit of a consolidation near the highs as it likely to find some support from a confluence of a short-term upward support line, as well as the horizontal resistance level it broke out of in July. So that's at $90.50. So we expect price to just sideways with some near-term supports hold the price at these highs. Next slide. This slide is about the summary of the technical trades initiated last week. So for KSH, here our stop loss is down 6.6%. Then for Hong Kong, it's still in progress. It's currently down 4.7%. Next slide. Then this is my last slide. So this is just an update on the technical calls that we actually initiated in July and whether some of them are still in progress. So in general, you will see the status of some of the counters that are still in progress, that's in white. And then those in green and red. So green is those counters that actually hit our TP, and for red is those that hit our stop loss. So in general, we heard Yen, Lot, Nam Chong, Propnex, Coinbase, Strategy, as well as Oiltek hit our take profit levels. For New Holdings, Takraw, Intel hit our stop loss. Those in progress is still CLI, so that hit our first take profit level still in running. For Ford, it is still in progress. Yangzijiang Financial as well as On Semicon still in progress as well, while hitting their first take profit levels. Next slide. Then this one is another set. So this one we've seen for DBS, Circle, Lei Chun, ISO Team, and Full Empire hit our take profit levels, and the rest are currently still in progress, which are the S3 ETF, ST Engineering, iShares Bitcoin Trust ETF, Joe Energy, Raffles Medical, Singtel, Mermaid Maritime, and Tuansing, as well as Alphabet. Yeah. Then for the iShares Bitcoin Trust ETF, Mermaid Maritime, and Alphabet hit our first take profit levels. Next slide. Yeah, then last but not least, this one for SingPost and KSH, it hit our stop loss. Then the rest are still in progress. Some of them hit our first take profit level, such as First Resources, Bhumitama, Agri, Seatrum, as well as SETS. Then the rest are just still in progress. Yangtze Shipbuilding, Nebius Group, Hang Seng Tech ETF, Hobby Land, CNMC Gold Mine, as well as Hong Fong. So that's all from me. I'll hand over time to Paul to talk about Oiltek results. Thanks.
Yeah, thanks, Zane. So we move on to Oiltek's first half results. So the PATMI was within our expectations. The underlying profit, if you exclude for FX translation loss, because they held US dollar, and of course US dollar depreciated, and because of that, they and then translated into ringgit, sorry, and then they had some loss in the currency. If you remove that, you will see that earnings jump about 92% year on year to ringgit 17 million. If you look on the table on the left, underlying PATMI, the positive for the results was the gross margin expansion. It really blew past our expectations. The margins expanded by about almost 13 percentage points, partly because they mentioned because of procurement savings and also some re-engineering savings. So that has been the cost. The negative has been the contraction in the order book. So if you look on the left at the very bottom, the order book fell about 18%. But we do expect them to kind of replenish. I think they did mention that the priority, because they recorded a record high in orders, so they wanted to focus more on this, making sure they execute, because they never had such high orders before. So in terms of outlook, we maintain our earnings, but we did lift our FY26 earnings by 20%, because we are looking forward to them to Oiltek closing some of the SAF or Sustainable Aviation Fuel Oil contracts or projects. I'll explain later. So we're raising our valuations. Of course, the share price has skyrocketed, but we are raising our bull case scenario. So listed peers in Malaysia, there is no exact peer, but if you look at the report, some of the process engineering proxies, they are trading about 19 times 2 years forward. But with a slower earnings growth about 16 times. But in the meantime, the Oiltek growth has been compounding around 50% the last 2 years and probably will continue. So we are just pushing our valuations to about 35 times. They've already hit historically at 45 times, and we don't see any slowdown in the earnings growth. So what can drive the order momentum is critical for us is the SAF pre-treatment units. So what this means is that more and more airlines are raising. I think like Singapore Airlines is pushing their use of sustainable aviation fuel oil. That means they're going to blend that in to 5% by 2030. Some have hit 10%. I think right now global use is probably 0.1 or I don't know, less than 1% or 0.7%. So we are expecting them to secure some contracts for SAF. And SAF usually, I think they signed one deal with Pertamina, but that was still letters of agreement. So that we're waiting for that to come to fruition. They also signed one in Sarawak, and hopefully they can sign more in Malaysia. So what they will do is they will provide the feedstock. Just a bit of explanation what they will do. They will take the palm oil waste oil and then treat it and then feed it into the SAF plant. On top of that, we hope that they can take a stake into this plant and get recurrent earnings. Other projects that are still pending, we hope that they can secure will be in Latin America, refining biodiesel that might be occurring regionally, and also more new refining capacity in Malaysia and also Indonesia. Next slide. Move on to Sheng Siong. So if you go back to the title, so operating leverage will return. So the reason for the title is because the second quarter earnings was a bit slow, but we think because they opened new stores. Next slide. So if you look at the results, it was within expectations. The first half was within our, within the 50% range. The positive, they continue to hit gross margins. So every quarter, they're almost hitting record highs in gross margins. So if you look on the left, the gross margins was 31.4%, the all-time high. And also, they also grown the footprint, which is the main growth for them, about 11%. If you look under area, there is 11%. But however, you look at the PATMI, which is the net profit, after tax and after minority interest, it only went up 1%. So earnings only jumped 1%, despite no gross profit up 9%, mainly because of the staff costs. There are a few factors here in why the staff costs only jumped 13%. Firstly, of course, when you open new stores, because they open 9 new stores, you need to employ staff. But it doesn't mean that when you open the store, everybody rush in and start to buy everything. So it will take some time for the revenue to grow. So that will of course definitely going to hit the margins in the near term. Secondly, of course, the whole the wage credit scheme, where the authorities has been pushing up the wages for cleaners, wages for cashiers. So that has also progressive wage model. Sorry, I just slipped my mind. Yeah, so that has also impacted why they need to raise wages, and of course the generally tight labor environment, which I think they said that it could be softening. So we do expect wage costs not to rise as much. In terms of the outlook, we maintain our forecast. But what we did was we actually raised our target price from 189 to 230, mainly because we push off the valuations. Of course, there's no science in this. There's like, why should it trade at 23, 18? But so we used to use 18 because this was what they were trading in the past 5 years. But now that it's pushed up to the highs, I mean, the whole market has re-rated small mid-cap stocks, and we cannot kind of ignore it and just go back and say, oh, it's going to be only 18 times. So we pushed it up to 23. We used 23 because that was the average that they had in 2014, 2015, when they had another growth spurt, which we think Sheng Siong will enjoy that growth spurt because they are adding more stores. So in terms of the last bullet point, what can help Sheng Siong is because they are really adding stores aggressively. So this is the highest number of stores they added since, I don't know, the last 7 years, or 2018. If my math's correct. And then with the higher gross margin, so we just think that it will take time for operating leverage to creep in. So what it means is that you got all these staff, so it takes time for revenue to grow because it's new stores, right? It can't be like day one you get the and then we also think that wage growth will decelerate. So we think that growth will recover stronger from the second half onwards. Okay, thanks. Next slide. I got 2 more companies. Okay, so for Keppel, obviously there's a very weird title here. So why we say the Hong Pao draw? So those who do not know, if you buy Sports Toto, there's a big Hong Pao draw every year. So what we mean is that they provide clarity on the assets they're going to dispose of, which they never did before. Next slide. Okay, so actually operationally there was nothing really major to highlight. The most important was more the buyback and also the assets to monetize. So the results was generally within our expectations. Strangely, the thing that were most positive operationally for us was the legacy O&M. So if you recall, they bought back the REIT Co. I know it's a bit complicated here, but they have this bunch of all REITs that they now took it back and they're operating. And actually the performance of the REIT Co, if you look at the bottom red block here, the losses actually improved. Although they the losses has improved. So that is why, and because if the losses improve, then it makes it more likely that they can sell these assets. That's why we thought it's positive. The negative is the infrastructure earnings. So if you look at the earnings, I mean, almost 70-80% of the earnings come from infrastructure. So infrastructure, just as a refresh, is basically power plants and renewable energy. So most of the earnings for Keppel still comes from that. And also some asset management inside there. So that was softer because of weaker spark spreads, and also because of KIT having some lower transaction fees. So in terms of our outlook recommendation, the highlight and what helped the share price run recently was because they as you know, the story for Keppel is not just the operations, but also the amount, what assets are they going to sell. That's what we mean by Hong Pao draw. After they sell assets, they were going to give a special dividend or so forth. So they actually separated for the first time almost 14 billion of assets, which they think they can sell. Of course, they cannot give details in there. But strangely, M1 is not in there, but we'll explain later. So this is about 5 billion of assets that they can sell. The other thing that helped the share price was they mentioned they're going to do a 500 million share buyback. So in addition to the EQDP or MAS 5 billion, we now have 5.5 billion to support the Singapore market. I'm just kidding. But We maintain our earnings, but we actually aggressively raise our target price and buy recommendation. We'll explain why later. But we think FY26 would be the real banner year for Keppel in terms of operations. Because in the second half, what they will have is the Keppel South Central. It's an entire new building, so of course you're going to get rent. It's 50% occupied now, so that will contribute more meaningfully into FY26. Probably some contribution in the second half. Then of course they have this new Sakra cogen power plant, which will boost the capacity by 50%, almost 50%. The earnings will come in 26, and of course they have this Bifrost cable completion, which they will generate O&M revenue, and of course earnings through their private holdings. Next slide. Okay, so for this, we give the valuation here. So what we did is we raised the PE for several of the divisions, and we removed the 20% holding company discount. Because it's very clear right now that, or should it be clearer, but anyway, it's clear right now that we give holding company discount or conglomerate discounts because some companies own assets that have no synergies. But I think because now Keppel has moved into an asset and operator model, they actually, all the businesses have synergy with each other. So like infrastructure, before they build a power plant or more like a renewable energy plant, they will tap on their asset management to raise the money. Then when they set up a new real estate fund, they will also tap on the asset management to raise money, and infrastructure will also do the O&M. So that's why we removed the 20%. This is a rough breakdown of the assets. So the value for them is from the non-core, of course, by disposing it. Then real estate, which is property, which we gave a 30% discount. I won't run through everything. So for infrastructure, it might be a bit soft now, but the main thing will be the new power plant. For asset management, is going to be the M1 that they acquired, the asset management fees, and of course Keppel South Central. Then for connectivity, of course, everyone is interested in M1. So they said that although M1 is not in that 14 billion that I mentioned, but they are open to divesting it. Asset management, which is a new business for them, which we gave them 20 times PE because asset management is growing strongly. So they are targeting 100 billion of funds. Non-core is where the Hong Pao draw is. So that is 14 billion in roughly mainly in property, the REITs and so forth. Yeah. Next slide. Okay, so I got Raffles Medical. So for Raffles Medical, the title, what we are trying to say is that Singapore operations, I don't think it's going to grow strong. It will stable, but maybe low or mid-single digit. But they are returning capital aggressively. Yeah, and at the same time, the real growth for Raffles is going to come from China. Yeah, next slide. So that's the narrative. Yeah. So the results are generally in line. The positive was the insurance. So just a reminder, Raffles now also has insurance in the earnings. So the losses has narrowed. Used to be they lost 7 million last half. Now they lost 3 million. So that also helped the earnings. The weakest one for us is just slower revenue growth. So we're just a bit concerned because Singapore not growing well, and then you have pressure on foreign medical tourism. We kept our target price earnings all unchanged, and that's why we maintain our target price of $1.02. Like I mentioned, growth in Singapore will be tepid. The key thing for China, for China, everybody goes to the large government hospitals because that's where all the best doctors are. So as a private hospital, your key ingredient is you must get the specialists. So they are trying to work with government officials to try to bring the specialists over during weekends and so forth, because people come to hospital for specialists and not because the building looks so good. So that's, although their building is very new and very nice, but you still need the specialists. So it will just take time for them to get the specialists in. The last bullet points, of course, they reiterate one thing about Raffles, that they are very aggressively returning capital. So they have about 300 million net cash. So they still commit to the 100 million shares. As of 30th June, they have 33. So they got another 64 million to buy. And you'll notice like almost every day they've been buying back shares. So that's the one thing positive about Raffles Medical. Next slide. Okay, I'll go through our usual weekly. I know, sorry, today is very long. So for RevPAR, just very quickly. So RevPAR is basically a hotel rooms and that. So, but basically, the hospitality or tourism in Singapore is a bit soft. I mean, the RevPAR is down. Year to date is about flat. So, but one thing good for banking sector, I think Glenn will share more in his monthly update, is that loans is growing in Singapore. Payrolls we'll just run through later. Next slide. So I try to do as fast possible. So in terms of tactical views, actually the US had two very negative news. So although the US GDP was 3%, so everybody can clap hands. But if you go into the details, most of it came from lower imports. So I mean, it's a very weird thing about for GDP. If your imports decline, it's actually good for the economy. Which I mean, of course, in reality, it kind of shows that economic activity is slower, but you know, these economies, right? And the other negative is that corporate spending was down. So this is assets, and then consumer spending was tepid. So actually, the GDP, if you look in details, actually quite big. The other thing is the payrolls. Of course, we all saw this is all over the headlines, but payrolls was 73 against 100,000. But the most shocking thing was that the revision. So the May-June payrolls, basically, you can say it was down almost 90%. 90% down means it's almost like fake. It's almost like fake payrolls. Totally cannot rely on. So they actually cut the payrolls by 258,000. So payrolls now in the US is only growing about 17, 18,000. So what it also means is that we're not even sure if this 73,000 is real. You do a 90% cut, then it means payrolls only grew 7%. But if you do another number check, the number of unemployed, which the BLS disclosed for almost 6 months, is actually 1.8. This is the highest since 2017. So the labor market in the US, although Trump sacked the labor statistician, is still the weakest since 2017. For Singapore, of course, we are the beneficiary. Of course, our exports is lower than the rest. Small caps really hard. Some of the big winners in our coverage was all this you can see. So these are the big. The big ones will be Venture, DBS, and UOB will be releasing their results on the 7th, and Sembcorp Industries on the 8th. These are some of the events. We also have Takraw on the 20th. I'm not put in yet. Yeah. Next slide. I think I'll just skip all this in your time. Next. Next, I think we got no time. Yeah, next. Okay, so just if you go to the earlier slide, this is just the tariffs. So thankfully, Singapore is only 10% compared to the rest. Next. Southeast Asia is normally around 19. Okay, so in terms of the July, we normally give a flash of some of the sectors that performed. Conglomerates did well. I think Keppel and Sembcorp did well. This is just for your reference. Some of the big gainers was Oiltek, Banyan, Clearbridge, losers, Singpost, MM2, Q&M. And the one at the bottom are the big index gainers and losers. We cannot use STI or else they want to charge us money. So we use SPDR ETF. So DFI, CDR were the big winners, and losers was a lot of the REITs I can see here, Mapletree, Industrial, and so forth. Next slide. Okay, so this is just in US dollar terms, again, just for your reference, what performed well in July. Blue line is year to date. So this is in US dollar terms, just for everyone's. So Singapore has actually done well in US dollar terms. We are 16%. So finally outperforming the US markets. Next slide. This is in local currency terms. So these are all the Asian markets in local currency. Of course, everyone is in awe that Thailand. So everyone is going bargain shopping, or they're also doing shopping in I'm just kidding, because they're doing the shopping in Thailand too, because the share price dropped so much. Because if you add, if not the recovery, I mean, Thailand would have been down almost 28%. So small caps has been one of the big winners in the whole of Southeast Asia. Again, just for your reference. Next slide. Yeah, this is our model portfolio. So we were up about 13%. For the year, we're up about 19, beating the Singapore market about 10. Next slide. And okay, yeah, thanks everyone. You can move on to Q&A. Yeah, sorry, this to them is very long. Yeah, so.
Yeah, thanks, Paul. Let me just take some of the questions first. Let's see. Yeah, someone asked in the chat, how much is the next OCBC dividend? I think you're referring to what is our forecasted dividend, right, for the next, I guess it will only be released in the fourth quarter. So we have factored in the fact that they are still sticking to that 50% and 10% payout ratio. And also, we also factored in some decline in their earnings. So after all that is factored in, I think the final dividend, we are expecting around 42 cents. And then the special, which is 10%, will be around 16 cents. Yeah, so all in, I think we'll be looking at around 58 cents. And for full year 25, it'll be just below $1, so 99 cents. So that's what we are forecasting for FY25. I hope that is the question that you asked. Now let's move on to the Q&A. From Ian here, what is the outlook for Singapore banks for the rest of 2025? Will we see similar lower profit for DBS, UOB after OCBC reported lower profit margins? Any new TP for the banks? Yeah, so I'll go in order. So the outlook for Singapore banks, I think what OCBC has reported will be pretty similar, for the other two banks. But I think maybe in the terms of the quantum and how much it shifts will be slightly different, right? So OCBC, we saw a significant or at least a healthy increase in their fees, but then the decline in the net interest income was it more than offset whatever increase that we saw in the wealth management and fee income side. So that's why they had this hit in their total income, in their net income. In terms of for the rest of the year, I guess we will be seeing this similar decline in net interest margins. I think it will continue to get compressed, or at least it will, it definitely, I don't think it will go up, but we will see it hovering around these levels. And then in net wealth management side, I think it will still grow at a strong level because of the lower interest rates, and then they're also trying to push very heavily by hiring more RMs, pushing sales harder than they were, say, a few years ago when interest rates are very high. So that's for provisions. I think they are cutting back on the general provisions because, if earnings are not strong, then, if they pile on more and more provisions, then we will see earnings decline even more drastically. The fact that they are able to do this and not put on so much provisions because they already have this huge stockpile of provisions that they have hoarded since COVID, right? And they haven't really released a lot of it. So I have a feeling that if, say, we see a huge decline, or larger than expected decline in net interest income, right, which will affect their bottom line, we could see them releasing some of this because it's been almost like 4 or 5 months already since the Liberation Day, right, and the initial worries from the tariffs, and now that the tariffs have sort of settled down, we could see that the banks will release some of this because they have a huge sum. Only DBS actually says how much they have, the rest don't say. But based on DBS, they have like 2.5 billion of management overlay, right? And that's a lot. And in COVID, they didn't release much. They didn't use any of this, and then now they are just putting on more and more. So we could see them release this to sort of, I guess, inorganically bump up the earnings, so it doesn't look so bad. Yeah. So that's for the outlook for the rest of the year. For DBS and UOB, I guess we might see lower profit, but I think the main difference between all the three banks, right? For OCBC, the first thing is that they didn't cut their current account rates as early as UOB, and also it was quite high, right? They only cut it quite recently, at least a major cut, and then it only came in effect in 1st August. So we didn't even see it really flow through in the second quarter results. I think there's one more question asking, when will we see this flow through? We will probably see in the 3rd quarter and in the 4th quarter. So if they look at their figures and say, oh, okay, we didn't cut enough, because they're still relatively quite healthy. They're just somewhere in between DBS and UOB's kind of interest rates. So, they say that, okay, we might need to let go some of this in order to improve the funding cost and to helpfully manage their net interest margins. Then we will see them, doing maybe more cuts in the future, right? So that's the biggest difference with OCBC, and also that their fee income doesn't really make up as large of a proportion as compared to the other two banks, right? So that's why, although we see fee income having like double-digit growth, it couldn't really offset that decline in interest margins. And the last pointer for OCBC, why we saw this decline is also because they have quite a large portion in their Hong Kong dollar, which is fully, as they say, it's 100% of its floating rates. So when the Hong Kong dollar, the HIBOR rate dropped very sharply, right? Their impact was almost immediate to them. That's why we saw this net interest margin compression of 28 basis points. Yeah, the TP for the banks, so OCBC, we have the new TP, $16.50. For the rest, we will update again, when the results are out. Let me see the other. I think I have a few more questions here. So OCBC reported insurance income lower, but this is in contrast with what we saw on GE earnings, which was up significantly, which should be positive for OCBC. Am I missing something here? Yeah, I think not that you're missing something, but maybe the figures that you're looking at might not be the correct one. So you should be looking at the TWNS, or total weighted new sales, which is in effect their revenue, the top line for GE, and then also their profit from insurance business, which is the net profit, right? So both of these actually dropped. And it dropped quite significantly if you look at the second quarter figures. So those are quite in line with what what OCBC has also reported, right? The drop in both of these. Yeah. So maybe look at those two figures instead, because those two are the largest contributors, and also what you'll be looking at. I think the only thing that rose was the NBEV, which is the new business embedded value, but that's also quite small. And the profit from shareholders' funds, which is also relatively small if you look in comparison to the profit from insurance business. Yeah, so I answered this one about the OCBC NIM. Yeah, I don't think it will improve, but it will sort of help to offset, the decline that we saw in terms of their loan yield when they reduced the 360 saving account. Yeah, there's one about iFast. I don't think there's any question here, but it's really just a statement. Yeah. Yeah, so I guess for iFast wise, it was I think it was a pick back up in the Hong Kong business, which helped to cause the bullish expectation, because they gave a very like they lowered their guidance a lot for the Hong Kong e-pension business, but then I think it performed better than expected. Maybe it was also part of their strategy. You give a very low expectations, then if they over exceed, it looks better. Okay, I think maybe that's all for me. Just give me one more on I think the outlook I gave for the 3 local banks. I think Zane will do the TA part. So the OCBC dividends, we're looking at 99 cents for full year. So if you minus off what they gave in the first half, the interim dividend 41, so we are looking at 42 cents for the final dividend, and then 16 cents for the special dividend. That's just based on our estimates and our forecast. Yeah, okay. So then, I was thinking that I'll get this question. What's next for GE? Will it be relisted? I gave a presentation on this with some slides, right, on the scenarios for GE, I think last week. So I will just go through it quickly again. So for the next step for GE, now that they gave this bonus share 1-for-1, how they are, it's quite creative way, because the way they're doing this is that OCBC will take the non-voting shares, right, for the bonus issue, because as all the shareholders have a choice, I guess. You can either take ordinary shares, which has it's just a normal share, or you can take the Class C non-voting shares, which has the economic benefits of an ordinary share but doesn't have the voting rights. So that's how they are making their free float go above 10%. So OCBC will be taking fully the Class C non-voting shares, whereas the minority shareholders will be by default getting this ordinary share. So you can opt for the Class C non-voting shares, but it doesn't make sense, economical sense, because if you do opt for this Class C non-voting shares, and let's say they get relisted, right? These shares they don't have any voting rights. A lot of benefits are not there. The only thing that you get is that you just get dividends, right? And also, you as a minority shareholder, you would benefit if you would get it relisted, so at least the shares that you have can be traded. You have an option to sell these shares or to let go of it if you want to. Yeah. So if they do go through, then it will be relisted, but there is a risk whereby if let's say a portion of the minority shareholders choose for this Class C non-voting shares. Based on our calculations, it needs to be more than 35% of minority shareholders take up the Class C non-voting shares. Then that's where we'll see the free float actually go below 10%, right? It doesn't go above that 10% threshold. Then GE will be then again stuck in this limbo where they are trading is suspended, but yet they cannot privatize the company because they don't have enough. They don't. Sorry, not enough minority shareholders actually accept it, right? So that's the worry where more than 35% take up the Class C non-voting shares. Yeah, but for now, I guess the default is just to take the ordinary shares. So you must really opt in and write in and say, I want the Class C non-voting shares. Yeah, I hope that is clear enough. So that's all, I guess, for me. I'll hand it over to the rest of my colleagues. Thank you.
Thanks, Glenn. Pick on some questions. There's a question, what's your view on AEM? Is this a buy? Yeah, so for AEM wise, as of now, I don't think it's a buy because I mean recently there's a change in CEO and there's a so I attended a talk from the CTO. They couldn't disclose much because it's their blackout period, but I think basically AEM this new CTO has a lot of experience in the tech side. He said he has he's involved in 80% of the high performance compute technology. So I guess AEM wants to realign themselves to focus more on the tech development side of the business. But however, their main customer Intel did not disclose very positive results. Their forward guidance for the next quarter is minus 1% year-on-year decline. And Intel also stated that because of capacity constraints for the next quarter, their results will not be that good. Yeah, so I think for AEM wise, their forward PE is also just a slight about their forward PE is about 20 compared to the average of its peers about 22. So it's also not very undervalued. Yeah, so that's my thoughts on AEM. Yeah.
Yeah, and I think if you want to buy AEM, must buy AMD, right? Yeah, the story is the same, right?
Yeah. Yeah, like a direct exposure to US tech will be better.
Yeah, anyway, the rebound for AEM is ultimately their AI customer, which we think is AMD. So if you're going to buy if AEM really can their AI can really take off, then I mean it's AMD's AI can really take off, then I must just go and buy AMD rather than go and buy AEM. They got all this problem about CEO. Not sure their product even can perform well and accepted. Yeah, thanks.
Thanks, Paul. Yeah, just one more question for me. What is the fair value for WeHer? Price has shot 40 to 50% in 1 month. Is it still undervalued? Yeah, our latest report, our target price is 0.55. Yeah, so I'm aware that the price has shot beyond our target price. But however, I do think that there's still upside because for WeHer, the net asset value per share is 0.71. So currently it's trading about 0.67. So there's still a short differential from its book value per share. Compared to its peer, Centurion, I think its book value per share is about 1.35 if I'm not wrong. But currently it's trading about 1.7. So Centurion is trading at a premium to its book value per share. But of course, it's not a very close comparison because Centurion has spun off its assets into REIT compared to WeHer. But I do think that WeHer, the upside will come from, first of all, its worker dormitory. There's a 60% increase in capacity. Secondly, there's also assets that it wants to monetize from next year and beyond. They have a remaining 13% stake in the PBSA that they have sold off, and they are also coming out with additional funds for their student accommodations. And they are also, they have just won some contracts for their construction segment for BTOs. Yeah, so those presents upside for WeHer. Yeah. So I think it's still undervalued. Yeah. I think that's all for me for now. I'll hand over the time to my other colleagues. Thanks.
Yeah, thanks, Ivan. Yeah, there are a lot of questions on the Astrea. Is it worth subscribing to Astrea 9 bonds? Any guess of the performance of both class bonds on first trading, day of trading? Yeah. So similarly to equity, right? Usually when the allocation is so highly oversubscribed, right? Like usually historically we saw like Astrea 8, I believe was 3 times, 7 was also 3 times oversubscribed. Then usually on the initial day of trading, the price will go like 1-2%. That's just what you've seen now. So I think that perhaps would be my guess on the performance also. Because yeah, we've seen a lot of strong insti demand. Like initially guided the retail tranche will be higher for class A1, but because of the strong insti demand, they allocated more to the placement tranche in the end. Yeah. So that would be my guess. I'm just a part-time credit analyst, so yeah, don't quote me for this. Following the question of Wadi subscribing to Astrea bonds, please comment on liquidity. Yeah, so Fahmi, could you go back to the Astrea slide? I think there's another the table on the so currently there are 6. Yeah, thanks. So previously there are 6 Astrea bonds that are in the market that are trading. 1, 2, 3, 4, 5, 6, 8. Yeah, then that is a indicative offer pricing, but usually we see the bid-ask spread is around 0.5%. So that is the liquidity there. It might not be liquid, but I mean the bid-ask spread is still is relatively thin at 0.5%. So it's still okay. Like maybe the bid is $1, the ask is $1 and 22 cents. Like, yeah, something like that. So it's a very thin bid-ask. Yeah, so it is okay, relatively okay. But like I mentioned, the comparison, like the yields for this Astrea 9 is already much lower as compared to the Astrea 8, where it was just 1 year ago, like almost 1% lower. Yeah, but there's another question: is Astrea capital protector or guaranteed at maturity? Yeah, definitely not. It's not capital protector. It's not guaranteed, but at least you know that in simple terms, before you lose any money on fixed income, you'll know that the sponsor will lose money, the equity stake. So basically, the temasek will lose money before you lose money in your fixed income. There's another question on that. The simplified priority of payments. Yeah, so that's on the left-hand side. Yeah, I think there's a comment on that. Yeah, so that's the chart there. So basically, the class A1 and class A2 bonds that the retail tranche can invest in is very high in seniority. So you get paid immediately after all the immediate costs like the taxes, the hedges, and all for credit facilities, the fees. So yeah, we paid very senior. Yeah, so in that sense, the risk is much lower. Yeah, like you see the bottom one, clause 13, that's the equity investor. So that's the sponsor stake. Yeah, I think there's one more question for me. I don't know. Wait, there's a few actually. So, any full allotment of subscription of 50K or less for Astrea 9 bonds as previous one given at full? Yeah. So this one, 50K might be a little bit the higher end. So I don't think if you apply for 50K, you get 50K. So yeah, I don't think you get it because we've seen it have quite strong demand. Yeah, especially since the Phillip placement tranche is also already full already. Yeah, so yeah, probably if you bid for smaller value, then perhaps you might get. Yeah, but 50K, I don't think you'll get it. Yeah. You probably just get a smaller portion of the 50K. Can you comment on Astrea 9P bonds with the fixed interest rate are worth applying? Yeah, so if you invest in this Astrea bond, basically it's still a bond. So the risk is much lower as compared to equity, but the yield you're getting is also much lower. Like just compare it to perhaps a local bank or a REIT, where you're getting like 6, 7, 8% yield. So that you get the risk of the equity. And yeah, so it really depends on your risk appetite. If you are very risk averse, yeah, this is more of a bond. I mean, it is a bond. It's more bond properties than equity. So as a result, you're also getting lower yield. Yeah, but it is relatively safe because an investment, because there are many structured safeguards in there, like I mentioned in the presentation. Yeah. And what do you expect for CICT Ascendas? Yeah, so for CICT, expecting the reversions to remain very stable, like the retail side, perhaps towards the higher end of the single digit positive rent reversion. Office, for them, because of the fact that their current leases are slightly higher than some of their peers, so the potential for rent reversion might be a little more challenging. So perhaps a single digit. Ascenda Street, we're expecting rent reversion to kind of soften as well from previous years. Yeah, so generally that's what we're expecting. Yeah, for the performance in this quarter. Yeah, I think I'll hand over to my colleagues for now. Thanks.
Hi, I'll take Zixing. Yeah, so we do expect some seasonality for Zixing in the first half. Yeah, first half tend to be like seasonally weaker due to the harvesting time. And the upside will come from the processed sweet potato this year, since like there will be 60% increase in their capacity. And currently they say shortage of sweet potato, so more contribution will come from second half onwards. Yeah, so they'll try to ramp up its production for the full year. And the new factory is also catered towards higher margin functional products like sweet potato powder. And margin is around 40%, which is double of the conventional snacks. And significant contribution will also be coming from sweet potato seedling, since they are doubling the total cultivatable area. Yeah, and for fresh sweet potato, we expect sales to increase by 20% year-on-year, due to expansion of the cold storage facility. And yeah, there was a question on CAO. Is there what's the reason for the share price and is there any upside? Yeah, so I tapped the answer in the chat box. Basically, the share price increase was mainly because of EQDP, which is the MAS 5 billion program. Yeah, so there will be liquidity injection for small to mid caps. And since CAO was trading at around its cash book value, like nearly at its cash. Yeah, and also with the expectation of a strong first half result, that's why our share price rallied. Yeah, but we don't expect dividend payout ratio to increase. So for first half, very likely they'll stay at 40%. Yeah, for its payout ratio. Yeah, hope it answers your question. And for CNMC, is there any upside? Yeah, so the issue profit guidance, basically for first half, they'll say significant improvement year-on-year for its profitability, due to gold price increased by around 50% year to date, and also increasing silver price, and also they already ramp up its CIL facility. So production is expected to increase by 60% year-on-year. And we are factoring in a 20% year-on-year increase in production for the gold. Yeah, any more upside is anticipated to come from its dividend. Yeah, we are factoring in 40% of its payout ratio, which translate to 5% yield and 2.4 cents for the full year. Yeah, so we do expect it to beat our expectation. Yeah, so upside will be mainly coming from the higher than expected dividend. Yeah, that's all for me. I'll hand over to Paul probably. Yeah, thank you.
Okay, I already typed most of the questions. What's the outlook for Wilmar, Food Empire, DFI, ST Engineering? Okay, there's quite a lot here. Okay, so for Wilmar, we are expecting a big set of results. Mainly because sugar price is down, palm oil price is flat. The crush margins also coming down. So that's our own expectations. For Food Empire, I'm not too sure, but because of the spectacular rise in Russian ruble, we can only expect it to be strong for them. there's a analyst briefing coming up, so we'll give you more details after that. For DFI, I think the results already came out. For SC Engineering, the results will be coming out on the 14th, I believe. We are expecting some strong numbers, but the valuations is pretty steep. We're talking about almost 30 over times PE forward. So for ST Engineering, it really has to be a blowout number. Otherwise, we are also getting a bit concerned about the valuations. Yeah. Okay. Paul, Citrum results is a big letdown going forward. Yeah. So I did tap the answer. So for Citrum, I mean, it's generally a trading. Just buy it as a trading stock. I mean, when the things are down, even with this kind of revenues, they can't even the profitability is still soft. So they only secured 1 billion of jobs this year. They did dangle investors with a 30 billion of projects that they're looking at. So again, never been positive on Citrum because we just think that the margins has always been a letdown. They are still stuck with some of the old yards since the merger, and they're not really shared some of these additional costs. Yeah, let me quickly do one before I hand it to Zain. SingPost, how does the future hold? So for SingPost, I think we did mention. I think near term we are not expecting much from SingPost. What is left for SingPost is of course postal business, which is not doing well unless they do a restructuring with the government. Number one, which we don't think is going to happen until year end. I mean, since it's technically a new government or new ministry. The second thing is that the sale of the mall, don't expect it in the next 6 months because they still need to build a new sorting facility in Tampines. So this is more like a 2026 story rather than now. So just that we don't think there's any particular news coming up. There's only the postal, and then they're already so famous. And then the mall. So there's really nothing much coming up for in the near term for me, at least from the news flow basis. So that's why so in the near term won't be much happening. Yeah, I hand it over to Zain. Sorry, the technical, we only have 10 minutes.
Thanks, Paul. I'll go through some of the technicals as much as I can with the remaining time. So first up is Oiltek. Now, so for Oiltek, I think it's still definitely very strong. So January 3 still finding support from the short-term 5 and 10-day moving averages, that blue and red line over here. I think if I were to pick a near-term resistance that could come from this trend over here, that my guess would be maybe like somewhere around close to $1.10 around the area. But nonetheless, I think still trend falling right now unless it breaks below this short-term moving averages supports. Next one is on China aviation oil. So also seen a strong rally towards, I think, hit a resistance area around $1.13 to $1.16 about there. Currently looks like a bit of sideways. Price is also with a bit of a break below the short-term moving averages and finding a bit of a resistance with the upper wicks around 115 recently. So I would expect some support, maybe 107, 108 around there. Price might just move a bit sideways for the time being. Next one is on Bank of China. So for Bank of China, I think still nothing much going on right now. We're still seeing continued range consolidation since mid of May. So that's around 440 to 473. Yeah, I think it's just still sideways movement until we see a break of either side. Okay, then I see there's quite a lot of questions for sets and SingPost in terms of technicals. So I'll talk about that as well. First one for sets. Yeah, so for sets, I think the trend is still okay. It's just a bit of a pullback in also with the general market pulling back recently. So he actually hit the resistance around this 336. So just doing a bit of pullback. I expect support to come somewhere closer to about 312 around there, which was this previous resistance. So overall, it's still a healthy trend going up. It's just some pullbacks recently. Then for SingPost, I think the trend is actually not very good. So previously price was really above this 53 cents level here, but it couldn't continue on. Yeah, we see a breakdown of the short-term moving averages, and then price is just breakdown of a few key levels along the way. this trend line support as well as now. We'll just hope it's back at this 48.5 cents, 49 cents level. So we might see some sideways over here, but I'm still quite negative with the increased volume of selling recently. It looks like, yeah, then also trending below the 5 So I think we might still see some weakness maybe towards 46.5 cents maybe. Yeah, since we're seeing a weak price action. Then I'll talk about the three local banks as well. There's some questions on that. So for first one, DBS, I think we're just seeing some slight pullback. Overall, that is still uptrend. Yeah, just some slight pullback on the daily, where I think here we'll likely find some support around this 47.40. Yeah, then short-term resistance will likely be around this 48.20 area. So we might see some sideways consolidation before the upcoming earnings. Then for UOB, also some pullback recently, a bit weaker, where you see price to hold this 36.80 level. So this was like a horizontal level price broke down. Also some of the short-term averages. Currently finding some support around 36, which was previously also this breakout level. Also there was a bit of consolidation previously at the start of July. So I will expect some short-term bounce over here. Resistance likely to come from about 36.55 was maybe 36.80 for the time being. Then for OCBC, also a bit weaker. So currently retesting a previous swing high that's around about 16.80 over there. So over here finding some support around there. Then we expect, I think, maybe some sideways consolidation for now, with some resistance to watch will be above this $17.10 level. That will likely be the near-term resistance. So in terms of the banks, I think some generally all pulling back recently, but DBS still remains pretty strong among the three of them. And let me try to answer some of those questions where there are more mentions. I looked through, there's quite questions on Seatrium and Samudra Shipping. Okay, so first one's for Seatrium. Yeah, there was a bit of range consolidation that took place, but then after the result, there was some semi increased volume. So over here, around 244, then breakdown of this 235 level, short-term moving averages as well. So finding some temporary support around 227 over here around the 20 ME level. Also previously this was like horizontal level, so we might see some bounce, but I will expect some weakness in the near term with this kind of price action recently after the results where there's a breakdown, and also with the high volume as well. So this 235, the 5 ME maybe 232 to 235 area will be a short-term resistance. Yeah. And the next support, if it does go a bit low, maybe around 218 about there. Then for Samudra Shipping, yeah, Samudra Shipping I think is still quite a very healthy trend. So price has been trending upwards along this short-term 5 and 10-day moving averages. Looks like a bit of a consolidation recently. After the earnings, there was a gap up over here, but some slight pullback. But finding support at these previous levels, there's around $1 and around $1, which is also a psychological level. So I think we might see some continued trend, maybe some sideways consolidation between like $1 and $1.06. Overall, still the trade is still intact as it's still holding this moving averages, and also this previous horizontal level at $1. Yeah, then above that, I think next resistance above 106 could be around 114 based on previous levels. Okay, then there's also questions on United Health. What's United Health? What's your view? What is it suitable to buy now? Yeah, so United Health, I think still continue on the weakness, especially after the breakdown of 300s and 290 over here. But I think my guess, if what's a better place to buy, if I look at the monthly chart, I think somewhere better if it does hit that price, maybe somewhere around 210. So previously this will be the monthly 200 MA level, which will likely be quite a strong support. And previously we would trace back all the way to 2019. This was also there was also a bit of a range consolidation support previously. Yeah, so that's around 200, that level. Then if you look back in 2008, when there was a big drawdown, it found support at 200 MA monthly. So there might be findings, it might be able to find some support over there. Yeah, if it reaches there. Okay, then try to take a few more questions. First one, Singtel. For Singtel, I think yeah, it's still trending quite healthily. Still an uptrend, a bit of a pullback recently. Retesting this very previous range resistance around 390. So expect to find some support over there, and looks like it might just do another sideways consolidation again, similar to what we saw in May to June this year. Yeah, so maybe now the range is about 390 to 410 for now. Yeah, sorry, it's about one. I think there's still a lot of TA questions. TA questions I can't answer in view of time, so I'm sorry for that. But feel free to post all of them in our Poems 3 community, and I'll try to take it over there. Yeah, thanks for all your questions. I have time to call to close the session.
Thanks everyone. Yeah, hit 1 PM because it's already 2 hours. I think probably gonna bore everybody after 2 hours. So anyway, thanks everyone for your time. I hope it was useful. Yeah, because today was a bit longer because we had so many results. Yeah, anyway, hope it was useful, and wish everyone have a wonderful week ahead, and also a happy National Day. Thank you, everybody. Bye bye. Zane, can you flash the community chat slide? Yeah. So this is our community. We if you put questions, we'll try our best to kind of answer them. Yeah, even technicals. Yeah, it's our P3 app. Yeah. Thanks, and good week ahead. Bye bye.